Imagine a world where millions of people with diabetes no longer have to prick their fingers or wear clunky external monitors. Instead, a tiny implant gives continuous, accurate glucose readings for years. Sounds like science fiction, right? Well, that's exactly what GlucoTrack is promising. But before you rush to invest, let us run the company through Warren Buffett's legendary investing checklist to see if it is a true long-term winner or just another speculative bet. 1. Business quality and moat business model. GlucoTrack is working on a fully implantable continuous blood glucose monitor (CBGM). Unlike today's skin patches or fingerstick methods, this device is meant to sit inside the body and deliver real-time glucose data for years at a time. The company is still in the development and clinical testing stage, aiming for regulatory approval in the coming years. Competitive advantages, if successful, GlucoTrack's advantages could be significant. Patented implantable technology with multi-year sensor life, real-time blood-based readings that may be more accurate than interstitial monitors, simpler implantation using tools already familiar to physicians. Durability of moat. The problem is that none of this is proven at scale yet. GlucoTrack currently generates no revenue. Big players like Dexcom and Abbott already dominate the glucose monitoring market. The moat is theoretical. It might exist if the product succeeds, but for now, it's a moat drawn in the sand. Management quality, leadership credibility. The management team has expanded to include regulatory, clinical, and medical device veterans. Early human trials have shown promising safety results, which suggests some operational competence. Capital allocation. Like most early-stage medtech firms, GlucoTrack is burning through cash. Research and development expenses nearly doubled last year, with total net losses rising significantly. Leadership has raised capital to keep the lights on. But at this stage, it's all about spending for development rather than generating returns. Shareholder alignment. On the positive side, management has taken steps to reduce shareholder dilution, like repurchasing certain warrants. Their focus on clearing regulatory milestones suggests they understand what actually drives long-term value. Still, until the company makes money, it's hard to measure true alignment. 3. Financial strength. Here's where Buffett would likely walk away. Revenue, zero. Not a single dollar yet. Profits. Deeply negative, with losses growing year over year. ROE and ROIC. Negative and essentially meaningless at this stage. Debt. Traditional debt is low, but liabilities from derivatives and warrants are large. Cash flow. Strongly negative, with heavy burn and ongoing capital raises required. The balance sheet is not overly leveraged, but the company survives by raising new money. That's risky for shareholders because it almost always means dilution. For intrinsic value, here's the problem. You can run a traditional Buffett-style discounted cash flow model on a company with no revenue. Any attempt is pure speculation. Best case scenario, GlucoTrack gets FDA approval, launches commercially, captures meaningful market share in the huge diabetes space. Revenues could eventually be in the hundreds of millions annually, making today's tiny market cap look like a bargain. Worst case scenario, clinical trials fail, regulators push back, or competitors outperform them. In that case, the company may never generate sustainable revenue, and the stock could go to zero. The range of outcomes is massive, which is the opposite of what Buffett looks for. 5. Long-term prospects. Industry outlook. The global diabetes epidemic isn't going away. Demand for better glucose monitoring solutions is rising, and the addressable market is huge. Any company that truly improves accuracy, comfort, and ease of use will find eager customers and insurers. Risks. Clinical trial failure or regulatory delays. Manufacturing and scaling issues. Heavy competition from entrenched players. Ongoing dilution as more funding is needed. 10-year compounding potential. If GlucoTrack clears every hurdle, it could compound capital spectacularly over a decade. But that's a huge if. The odds are stacked against them, given the regulatory and competitive environment. 6. Final verdict. Let's check Buffett's famous criteria. Understandable business. Partly, the concept is simple, but the regulatory and commercial path is complex. Consistent earnings? No, not at all. Strong ROIC? Not yet. Low debt? Yes, in traditional terms, but financial risk is still high. Attractive valuation? Maybe, but only if the product succeeds. Durable moat. Possible, but not proven. Conclusion. GlucoTrack is not a Buffett-style stock. It's a speculative medical device bet, not a predictable cash-generating machine. Investors who buy today are essentially gambling that the company clears every clinical and regulatory hurdle, carves out market share, and fends off competition. For those seeking Buffett-style investments profitable, cash-rich, with proven moats, this isn't it. For risk-tolerant investors who believe in the technology, GlucoTrack could be a moonshot. Just understand the difference. Buffett would likely pass, but speculators may still see opportunity.